It feels like we had a big bull market because we did. Right? Prices just pull multiples for all of the majors. But the fact that we created more wealth in one kind of digital gold than this massive Web3 vision and all these kind of extremely technical, massive challenges that we talk about every day, and that only created half of the value that digital gold created, that's actually insane.
Web3 offers a brand new petri dish.
Our job is to buy great tech at great prices.
AI is also libertarian, right?
Enable use case that people haven't been able to do today.
The next hundreds of millions of players, they will come to the market through mobile.
My personal reason why I could be bullish in the next 12 months is Hey everybody, welcome back to another episode of the Blockcrunch Roundtable with me, your host, Jason Choi, co-founder of Tangent. Now today I will be joined by my co-host, Sanat Kapoor from Dragonfly Capital to discuss something that most don't really want to hear about, which is the bear market. Now before I start, I want to give some context. I've dedicated my career for the past 6 or 7 years to crypto. I've invested majority of my personal savings into the space. I've funded with my own money teams to build things like wallets, browsers, security audit tools, apps, and spent more than 8,000 hours on the phone with founders helping with onboarding customers, investors, and hires. I was also a partner at one of Asia's first crypto hedge funds when the idea was mostly scoffed at. And now I'm very, very blessed to have the luxury of supporting 8 extremely smart people across the podcast, the newsletter, and my fund Tangent completely on my own dime with my co-founder, with no investors. Now, this is not meant to impress you, but really to impress upon you the fact that calling me a crypto bull would be a massive, massive understatement. Now, however, I believe one of the hallmarks of great investors, particularly in an asset class like crypto, where liquidity horizons are short, is the ability to navigate time frames. Now, in other words, are you able to reconcile potentially conflicting thoughts in your head? To be bullish on a sector and think that it will grow 10x in 5 years, and also think that prices are elevated and conditions are frothy, and maybe things can correct by 50%. Now, this one skill is what I will attribute to whatever small modicum of success I've had the luxury to have in this space so far, and one that I hope will take me and my team further. Now, recently I shared a thread on why I think there is a decent chance we've entered an inflection point. I define this as the flipping from an environment where prices generally go up to one where prices generally go down. Now, as a long-term investor, I tend to ignore short-term price volatility, with one exception. Now, if I think I have a credible shot at avoiding massive pain, which I define as a 50% drawdown on my portfolio, just to account for the volatility of crypto, or if I think I can massively increase my ownership in networks with lower prices, I would make that call. So even with the longer-term investors, if you offered them a time machine back to 2021 to sell Bitcoin at $71,000 and buy Bitcoin at $15,000 in December 2022, just a year later, even those who claim to have the longest time frames would probably take the opportunity because you can effectively multiply your stakes. Now, on X, I shared my thoughts on why I think we've been in the process of topping out as a market. This is not an easy call to make, and I acknowledged in the thread the exact scenarios that I would consider to be invalidations of my view. But given the potential downside, I wanted to share my thinking, and I'm really grateful for many of you who engaged with thoughtful disagreements who have since challenged my view when this post first came out, and even the countless trolls that helped drive engagement. Now, since then, many altcoins have corrected 30 to 40% of this recording, but in my opinion, this is not really a validation of my framework because I wasn't predicting that we get a market wipe right away, only that we're shifting into a regime whereby prices generally trend down in the absence of new external catalysts. So I've shared the entire framework on X. I'll include in the show notes below, but I'll recap here briefly for those who haven't read it as well. I'm very excited to partner with Yield Guild Games to bring you today's episode. You may remember YGG as the leading guild in Web3 that helped drive the success of games like Axie Infinity and Pixels, but they actually have much bigger ambitions than just that. I've really enjoyed co-investing with and learning all about gaming from their founder, Gabby Dezon, throughout the years. So here is Gabby to tell us more about why YGG is more than just a guild and why you should care about YGG as the dominant guild protocol.
Yeah, the way to think of YGG is that it's a guild protocol or a platform that wants to scale all guilds operating in Web3. For people to care about platforms, typically you have to jumpstart the content yourself, and we had to be the biggest guild in Web3, which we've done in the last 3 years. But for this year, we're really making sure that we want to scale guilds of all levels that can put gather community, bring themselves on chain, and go on quests that can have them earn crypto or own their own assets. And YGG is the protocol that will be able to scale that across all guilds.
So my framework is very simple. I think at inflection points, you have four things you want to look for. So one thing is a credible reason for the market to stay offside. So we saw this in January 2023 when people were expecting that grayscale blowup could happen, leading to majority of the market being offside or short. We saw this once again, just to give another recent example, in June 2022, where there were rumors of a big Chinese miner blowing up after the 3AC event, which led most people to be offside or short as well. In both scenarios, the market in the subsequent months massively punished people who were positioned on the obvious and credibly obvious side. And in my opinion, the credible reason to stay long currently for most people seems to be the launch of the ETH ETF. Now, this is also one of the big main invalidation scenarios for my framework. If the ETH ETF launches to great success, which some analysts are predicting it to be, then obviously this framework would fall apart. But that is the setup. So number two is looking historically, a lot of the wealth creation in crypto happened in altcoins, defined as coins that are not Bitcoin or Ethereum. So if you look at the last cycle, for instance, look at an index called Toto3, which is the aggregate market cap of all coins outside of Bitcoin and Ethereum. In the time that it increased 7x, Bitcoin only increased by 200%. Now, this time, the dynamic is flipped. In this cycle, since January 2023, Bitcoin increased by 300%, while Toto3 as an index increased by not even half of that. So there hasn't been much wealth creation in the crypto markets through these altcoins where retails predominantly participate in for a massive wealth effect. And the other point about that also is that a lot of the increase in Toto3 came from new supply in new tokens being launched, not necessarily people buying up tokens, with clear exceptions for things such as Solana. But there have been so many high FDV launches that added to this market cap, and it's been pretty clear that most retailers don't seem to have an appetite for that. Another big red flag for me is also the waning inflows of stablecoins. If you track the total market cap of USDT and USDC, we are entering some sort of a stagnating period for the first time since the beginning of this bull run. So that is the other kind of part of the setup. The third part of my framework is looking at just qualitative heuristics, which is a little bit harder to define. But looking at things like big funds being raised. There are multiple big venture funds being raised. This usually is a sign to me that the market is running out of marginal buyers. So obviously, in the long term, with venture capital coming into the space, I do believe that is bullish on development because you need capital to develop. But in the relatively short term, in the multi-months versus the multi-years time frame, that tends to be a decent signal that we've entered some sort of mainstream acceptance and penetration. And I think this is corroborated by celebrity coins being gambled on by the mainstream as well, which signals to me that maybe we are running out of marginal buyers for this market. And finally, the last part of my framework is the shortest time frame, the shortest term input, which I think is the weakest of them all, but was also a little bit of a red flag. Recently, we had what I consider probably one of the biggest pieces of news to come for crypto in the past, call it 6 months, which is SEC dropping their case against Consensus. I saw this as a massive precedent that the regulatory stance on crypto is softening, which is one of the big things that's been hampering development for crypto developers in the US. And the fact that this case was dropped, I would have expected prices to react massively positively. But the fact that prices actually traded down signaled to me that the risk appetite in the market was actually waning as well. Now, that is my 4-part framework. Obviously, all of these points have been debated on Twitter, and they could be disputed very soon as well. But this framework doesn't mean that prices go down in a straight line. And this podcast is not even about whether prices are going down or up, or where prices are going or where they have gone. This episode is really about the thinking process behind the stance and how founders, VCs, and liquid investors can think about this. Now, just to add a final note, I manage a fund that is both a liquid strategy and a venture strategy. And my co-host Sanat is part of a fund that specifically focuses on venture only. So in this episode, you can really see how our thinking differs, how our respective abilities and willingness to navigate time frames as well to fit our investment styles. Now, we talk about our disagreements on the ETF inflow expectations, some stories from the last bear market, signs of market exhaustion and supply of new tokens in the market that Sanat is seeing in the venture market, and some that I see on both the liquid and venture market. as well as why it may or may not matter for investors of different time horizons. Now, given my own preference and Sanat's background, this episode focuses a lot more on the higher time frame topics and tries to relate to mostly founders on what happens. Now, if you're curious to hear more about lower time frame market views or more degen views, as you call it, let me know on X. Maybe we can invite someone with a trading background to share their views on the show as well. Now, without further ado, here is this week's Blockcrunch Roundtable. I don't know if you got a chance to look at that tweet, but when you first saw that, what was your reaction, Sanat?
Yeah, I did take a look. It's funny, right? Like I'm probably like very unique in the crypto markets in as much as like I really play the pure venture capitalist role. And so like on any given day, I actually don't know the price of Bitcoin and Ethereum. I just like don't pay a lot of attention. But obviously the sentiment shift on the timeline is very real. I'm as addicted to crypto Twitter as anyone else, and you can feel kind of sentiment shifting quite dramatically. I was also surprised by the kind of lack of market response to the Ethereum ETF, like the fact that it kind of shot up in a single candle and just kind of made its way down. Surprised me a lot. I've seen a lot of kind of long threads and long articles on why the ETH ETF is not so bullish. Some of those reasons make sense, but I really think that overwhelmingly, like bringing Ethereum into the world of ETFs is bullish, and I would be surprised if it actually ends up being the case that 6 months later the ETH ETF saw no inflows or saw very low inflows relative to what kind of the market is expecting right now. I've never believed this idea that TradFi will not understand Ethereum. I just think like we are not giving TradFi enough credit. And quite frankly, as I said earlier, like I spend a lot of time on the VC side. And so without having like a specific view on where prices are, I think the two things that are really important to us are both helping founders navigate fundraising. And so, we have a lot of founders who are looking to raise next rounds. We have a lot of founders who are coming to us looking to raise rounds, trying to figure out valuations. One of the things I have seen, which is always an interesting signal, is that like I've seen founders drop their valuations very dramatically in the last month, particularly for some infrastructure stuff, which is always an interesting signal and is both a good and bad sign as a VC, I guess, given that some of them are your portcos and others are not. And the second thing that I think is the most important that I think we'll chat about as well is like there's a ton of founders thinking about token launch timelines. And given kind of disappointing token launches in the last month for some pretty big name projects, I think that's going to be kind of a big thinking point among founders in the space about what to do here, because there are literally like 50 plus reasonably high quality projects that were planning to launch a token in the next 6 months, and it really feels like the market does not have capacity to absorb 50 plus tokens right now.
I think that's actually a great point, because bringing back to the Total 3 argument, which is there hasn't been a lot of wealth creation in altcoins, which is where retails tend to participate in. A lot of that increase this cycle so far has been creation of new tokens versus like existing tokens being bid up, with the exception of things like Solana. And yeah, I do think the market is losing ability to absorb so much of this supply, right? So, for instance, Blast, I think, even internally, I thought Blast would at least be a $5 billion network, right? It's one of the more hyped up networks. When we had one of our team members try out everything on Blast, and genuinely, I think the applications on Blast are quite different from most of the other chains. Like with the exception of some of the earlier rugs, there's actually some quite interesting stuff happening there. Which is more than you can say for a lot of the other L1s. But this thing listed at like a $2 billion FDV, which is, if it's an equity value for a company, it's seen as high. But for a crypto network, that puts it in the vicinity of, things like VeChain, which I don't think anybody uses. So I was quite surprised by that. And the fact that you said, I think there's like 50 or so new projects coming out in the new 6 months. Like Total 3 could go up just by the function of having so much new supply coming in. But I don't know who's going to buy this. So that is a little bit scary to me. But I don't want to get too bear hold here, because I think people are a little bit confused on Twitter about, how is it possible that you're long-term bullish on the space, but you have this kind of short-term bearish view. So I think before we dive into that, we should probably define what a bear market even is, because I don't think people have consensus on this. When I say bear market, what do you think about?
I think a lot about the time post FTX, when crypto sentiment was at all-time lows. I had friends kind of calling me, being like, "Are you sure you made the right career decision? Like, maybe you wanna go back to Uber, bro. I'm sure they would give you a job." I literally had 3 friends call me after FTX, be like, "Hey, you had a job at Uber. Maybe you should go back and do that job."
Were those friends from Uber? They're trying to get you back there?
No, but they were all like Google people, and they were like, "I think you made a big mistake." And then, separate from that, I think private market valuations are actually very sensitive to public market valuations these days, and so you can kind of feel that energy flowing back in. And I remember valuations like a year ago were way lower and way less, and kind of it was a much tougher market for founders to be raising. But the last signal that I actually think is interesting is like just thinking about the quality of startups and the quality of founders. And that's like a thing that I think doesn't get spoken about on crypto Twitter. And a lot of people talk about VCs should be counter-cyclical. But one of the truths is that, like, for example, last summer, there were just not that many founders who were interested in building things in crypto. There were just not that many good deals. High caliber founders were nowhere to be found. They were either being patient and waiting for better market conditions or just not in crypto. And so from that end, I actually think it doesn't feel like so much of a bear market. Like, particularly relative to a year ago, deal flow is still like very much elevated. Maybe valuations have dropped a little bit, but we still see a ton of founders trying to build stuff in crypto. And, as an example, like, there's recently this debate about whether Ethereum should have pre-confirmations, which is basically a technique to get faster confirmations on a roll-up that is settling to it, that is using Ethereum as a sequencer. And it's like one of those things where Justin Drake mentioned this like 4 or 5 months ago. And ever since he mentioned it as a research idea, there are now like 5 startups building this. And so I think that we still see a lot of founder interest in crypto, in the crypto space. And so I think when that shifts dramatically is when I really feel like we're in a bear market.
I actually think that could be a lagging signal, because with waning deal flow, that tends to happen in the depths of a bear market, right? When you're close to the inflection point. I think if I am correct, which I think right now maybe like, in my mind, the odds are like 60%. We're technically in the inflection point between a bull market and a bear market. So the excesses are still there. The celeb coins are still there. There's still a lot of interest in this space. And in my mind, like when I think about a bear market as well, I think in equities, there's like a dictionary definition, right? If indices correct by 20%, that's a bear market. But in crypto, there's no such definition, right? Like an altcoin could go down 90% and the community members would still be like, tomorrow we're going to like 2x. So nobody really agrees on what it is. So in my mind, how I define it is basically extended period of time where prices generally head lower. But then because of crypto's volatility, you also have periods where prices suddenly go up like 50% in one day. So it's not a straight line down, just like things are not straight line up. In general, I think there'll be shrinking liquidity, meaning less and less market participants. And some of the lagging effects, like you said, on the venture side are deal flow kind of slowing down as well. But actually the signal of deal flow goes up a lot. I think I'd like to kind of quote my friend Richard, our mutual friend Richard from One Confirmation quite a lot on this, but every time you see a Web2 founder pivot from Web2 to Web3 in a bull market as prices are going up, as Solana just like 5x off the lows, it's usually a pretty bad signal because they are FOMOing into something they don't really have a thesis on. But if you're in the depths of a bear market, nobody's trading anything, there's no volume, everybody's convinced that Solana is dead, and then this founder basically quits their business, quits the lucrative job of like $200,000 salary a year to come in and build on Solana. That guy really believes in this. And I think, in 2022, 2023, there are a lot of examples of this as well. Well, not a lot, but there are a few examples. I think Athena was like a pretty good example, right? This is before ETH funding flipped, perpetually positive. So before we moved into the structural bull market, Guy, the founder of Athena, was already pitching a product that was designed for a bull market. So he was kind of had this vision of what's going to happen next, which most founders in crypto, I don't think actually have. They kind of just like follow what's happening now. But yeah, back to what a bear market is. In general, I like to think in longer terms as well. And so I like to work with founders on a multi-year horizon. I'm not really a trader type where I look at prices every single day. I do track where the markets are, but I think for me, my job within my fund at least is basically just to figure out what the inflection points could be and to better protect ourselves against it, just because we've seen what happens during inflection points, so many cycles. So for me, how I reconcile my long-term view and short-term view is that in the long term, right, I would never sell any of my venture bags just because I think a bear market is coming. Like we don't flip SAFs or anything like that. But our shorter term kind of liquid positions, things that we can actually risk manage. If you tell me that, hey, there's a credible chance that within the next 3 months, I get to double my size in these positions, in networks that I'm bullish on because the price has halved, then I'll be an idiot not to take that, especially if I think I have a credible shot of nailing that call. So that's kind of how I think about bear market frameworks. Another way I think about it is if there's a credible risk to your portfolio being halved in value in the next 3 months, I think that's like warrants action as well. But I know a lot of investors have kind of different strategies and different kind of fund mandates, which we'll talk about as well. Now, in terms of being a VC, you kind of touched on this a little bit in terms of like how it affects deal flow, but how does it affect your kind of deal sourcing or working with founders, or what advice you give to founders, or maybe types of projects you look at? If we do get that kind of inflection point and let's say prices just generally trend lower for the next few months, does it really change anything about the nature of your job?
Yeah, I think I'd say that one, VCs are generally price takers and also like kind of project takers in some sense. Like you wake up, founders show up or they don't show up, interesting projects show up, or they don't show up, and they have a certain price tag attached to them depending on the competitiveness of the deal. And it's your job to figure out whether you want to do it or not. You don't really get to control what's happening in the market in that sense. I think people group VC these days as one big category, but crypto VC has become large enough that there are funds, like Paradigm's last fund was $2.5 billion. And then there are funds that are $30-40 million. And so there's a huge difference between doing early stage and late stage investing. And I think I define it as like when you do early stage, seed stage investing, and let's say like competitive, high quality seed rounds of $3-4 million will be priced actually between 30 and 50 or maybe even $60 million, depending on market conditions. But in some crazy sense, if you're shooting for $1 billion outcome, it doesn't matter so much. Like, of course, your returns are pretty different when you invested at 30 versus when you invested in 60. But like if this thing is going to be $1 billion or $2 billion or $3 billion, it really does not matter so much. You are shooting for 10, 15, 20, 30, 40, 50 X's. And therefore, when you see a good seed deal, you should always do it. And if the market is competitive and it's pricing it at 60 instead of 40, I think it's like inane to be like, no, I would have invested at 40 and not at 60. Because, the return profile is just not that different if it is actually a huge success. On the other hand, with late stage investing, and we see a lot of this in crypto, like the pre-TGE round is a huge phenomena now. And at that point, the truth is that whether you like it or not, once tokens go live or are very close to being live, you are betting on beta. Like if you do an OTC deal with, as an example, I don't think there's a thing that's happening, but let's say you did an OTC deal with Arbitrum today. Whether you like it or not, the price of Arbitrum over the next 2-3 years is going to be a function of beta. And so late stage investors, I think, have to be very careful about market timing, and the larger kind of pre-TGE rounds, you definitely have to be careful. And that's something we think about when we're doing slightly later stage deals as well. Like market timing is not the biggest factor, but it matters. But we basically are totally willing to ignore market conditions for good early stage deals. And I think that's the right way to do it.
Yeah, I think that's a great point, right? I think this is something that a lot of people don't understand if they only participate in one aspect of the market. So because for me, my investment style is I do long-term venture investing where I'm very clear in my time frame. Right? The timelines for crypto networks at a seed stage is maybe they're 2, 3, 4 years away from token launch or from mainnet launch. So my holding horizon is at least that, is a multi-year time frame. And the more liquid you get, the more susceptible you are to beta. So any tokens that you can buy on an exchange by definition is already probably a late stage company, right? Unless you bootstrap the token as you launch the product. But for most of the tokens on Binance, for instance, it's already a product that's live, and the valuations are already at late stage valuations. We're talking about hundreds of millions to billions of dollars, if not tens of billions for kind of tier 1 projects. So for those, you don't really have the luxury of saying, hey, we got in at such a low price and there's the outcome of the project will the ability of the team to ship will affect the price more so than market beta. So I think you could make the case that, okay, if I buy Solana here, right? Solana is $60 billion. Maybe if the team ships a lot and we get way more mainstream usage, maybe we do get a $600 billion outcome in 5 years time, in 10 years time. But in the interim, right, in the kind of time frame that's within a year or 2 years, I would argue that majority of the price move has more to do with the broader market than what the team is doing. So you cannot be as kind of market secular or market agnostic the later stage you go. So that's why for the liquid portion of my portfolio, I'm very careful with kind of monitoring these inflection points. And it affects your founders as well, because it affects treasury management. A lot of projects have majority of the treasury denominated in their own tokens. And I think sometimes founders make the mistake of budgeting off of that without applying the proper discount. So if you have $100 million worth of your own token sitting in a treasury and you start spending like a company with $100 million worth of cash, 6 months after an inflection point, you might find yourself sitting on $20 million instead and needing to lay off 90% of the team. So that is something that we try to instill in our founders. We don't try to pressure our founders to do one thing or the other, because nobody knows where the market is going to go. We basically just highlight to them that, hey, these are the things we noticed during the last top, and this is what happened 3 months, 6 months, 12 months after the top to some of the companies. Just give you a heads up there. Is this some of the conversations that you had with founders as well, where they maybe reach out and ask, hey, Sanat, I think market's feeling a little bit frothy. What should we do with our treasury or hiring?
I think we always encourage companies to be capital efficient, and that there is definitely a sense of striking while the iron is hot. And so, the truth is companies are hot at a certain moment and then people forget about them, and narratives are hot at a certain moment. And if you strike while the iron is hot, you will be able to raise at a very high valuation, or it'll be able to raise a massive war chest. And so we encourage companies to think along those lines and figure out when is a good time to raise, when is not a good time to raise. One caveat to this I will say is this stuff matters less to the best projects. If you think of the most exciting L1 or the most exciting L2 or the most exciting stuff happening on the app layer, it just tends to matter a lot less because there are so few of those companies, and therefore they can always kind of manage this stuff. And so in a weird sense, you do have to think around this stuff. And for example, the pre-TGE round, you should probably do that, because at that point, in some sense, the option value of your company is the highest, and you get a whole group of investors who believe it could be worth a lot and just kind of take their opinions. And obviously the live price involves the opinions of people who are bearish on your company as well. So I think it is worth thinking about this stuff. You definitely don't want to overhire. You never want to overhire as a crypto company. And a lot of that is also just not, in a funny way, I think some of that is market and treasury stuff, but a lot of that is just companies that overhire tend to fail. Their organizational processes tend to be bad. And so we always advise companies to be careful when overhiring, and to make sure their talent power is really high. And I do think it affects fundraising timelines for sure, particularly for projects that are kind of struggling or kind of need maybe, let's say, a bridge round. I think projects that are kind of trying to pivot or raise a bridge round, or are generally not in the best place, I think they definitely need to be careful about timing market conditions and seeing where VC sentiment is.
Yeah, and I think it's not just treasury management and fundraising as well. I think the bigger part for founders with regard to the bear market is actually go-to-market, because the number of active addresses on chain and the amount of liquidity you have, which means how many people are using your DeFi stuff, and by extension, how many people can play your games or your on-chain apps and whatnot, they fall down drastically with the market as well. So crypto is deeply cyclical in the sense that the user base is the overlap of the Venn diagram between speculators and users. So when people are not making money on speculating, a lot of these users leave. So obviously you have some power users who find real utility beyond just speculation. But a lot of the applications today are kind of money applications or market applications. So for instance, DeFi, you could argue the majority of DeFi enables some form of speculation, requires some form of liquidity. And if that goes away, that actually hurts your kind of product market fit. So I think the biggest mistake that I saw last cycle was a lot of founders looking at existing trends in a bull market and thinking, hey, this is the be-all and end-all of the market. This is the equilibrium state of the market. Let's build a business off of this. And then as the bear market came, it washed out a lot of the things that people thought were here to stay. One big example is P2E and guilds. Right? A lot of people thought the scholarship model is how all games in the future will be built. And we actually invested in a very sharp team. They just had the wrong thesis at that time, which worked on offering buy now, pay later for NFTs for people to use in games. So you can buy now, pay later using their DeFi protocol, basically a credit protocol for guilds to sponsor scholars for things like Axie. So it sounded like a great idea at the time if you just look at the existing users, right? There's like 2 million, 3 million daily active users in Axie on the way up. So if you extrapolate, they could get to like 50 million users in 3 years' time. But that just didn't happen, right, when the bear market came. So confusing narratives and confusing kind of speculation for kind of secular adoption is one mistake that founders can make that they have to be very careful for. So trying to test out new products is easier in a bull market because there's a bigger user base, there's more liquidity, but also ascertaining what is real product market fit is also harder the closer you get to the inflection point because anything goes, right? Anything you launch will seem like a fair business. And, we talked about pump.fun before. My view was that pump.fun is purely a bull market phenomenon. Maybe they can pivot to something else, but in a bear market, do you really see the same number of people launching meme coins, the same amount of volume trading meme coins if price is half, right? I really don't think so. But like you said, I think founders who are focused on the 5, 10-year, 20-year horizon, they don't really have to think too much about this. It's really kind of applications that are trying to find product market fit and then iterate on it that have to be very careful what sort of signals they choose, especially during these inflection points.
Just very quickly on pump.fun. I'll take the other side of that, funnily enough. I know everyone thinks that meme coins are a very short-term phenomenon, and it's very possible that we end up in an NFT-like situation where kind of the market never, at least it feels like it's never going to climb back to the highs that it was in 2-3 years ago. But one, I don't know if you've seen their like weekly fee chart on DeFi Llama. It's really healthy, and if the last 3 weeks are supposed to be a bear market, pump.fun is doing totally fine. They're very consistently making $5 million a week. And more generally, I think that, I don't know why, I feel like we have like pump.fun in particular is very interesting, like speculation meta. And I'm generally of the view that meme coins feel like actually they have pretty high product market fit, which is not to say like, of course, meme coin volumes will fall in the bear market, but like Ethereum trading volumes will fall in the bear market. And so surviving crypto cycles is a big part of this, but I guess I've also had a chance to meet with the founder once, and I think he's actually very long-term oriented, and they're shipping a bunch of interesting features. So I actually think that there's something here that may outlast cycles, and I know most people disagree with me.
Yeah, I like how this comes up almost in every roundtable we do. So the interesting thing is, because if my view is correct, we're in net inflection point. We're not really in bear territory yet. So a lot of the excesses will still kind of take place, at least by my framework. And in my opinion, topping is kind of a process, right? You could have a few months of this excess, and Bitcoin could be trading between 73 and 58 for a few more months, and in that time, alts could pull a 3-4x. I would not be surprised at all. But then structurally, it's still not conducive for a very bullish outlook on, say, like a 3-6 month time frame on majors. Actually, yeah, let me clarify on that, because when I first posted my bear market views, I was mostly focusing on majors, right? ETH and BTC. And the assumption there is that alts are basically levered beta on ETH and BTC. But there could be pockets where that dispersion happens, which we've already seen for the past year, where alts are just not trading in line with ETH and BTC. So I think all I'm describing is basically a scenario where capital inflow seems to be shrinking, things seem to be very frothy. We're at a place where nobody seems to believe that we're inflecting to some sort of extended bear market. But the caveat is, things can still trade 2-3x up in the interim. So it's not as clear cut as saying, price is going straight down, founders buckle in. So that's something I wanted to clarify, just given how many people seem to have questions about that. I guess on your side, when you look at the general markets, right, are there any signs of fatigue that you see that are causing a little bit of concern?
The infra fatigue thing definitely feels real. And I think part of the truth about it is, and this is something I mentioned earlier as well, is that crypto infrastructure is now, like, the opportunities are far too legible and there are too many people willing to go chase them. And so one of the things you remember last cycle is that, like, when there were kind of esoteric ideas, there were like 2-3 teams that would go after them. There was very often one credible team. But that like never happens in infrastructure anymore. It's like we have this idea of ZK coprocessors, which are effectively startups that let you kind of access historical state via ZK proofs and make it cheaper to kind of build applications that leverage the historical state of a chain. This is an idea that took hold, I'd say, about a year ago. And now we have 5 credible startups. Like there's teams like Axiom, teams like Lagrange, teams like Previs, teams like Risk0 also are working on something like this. And so there's like 5 well-funded startups working on this problem. And very, very few developers have adopted this way of thinking right now. And so it definitely feels like there's just way more supply of ZK coprocessor compute than there is demand for it from developers. The pre-confirmations thing I mentioned as well, like pre-confirmations, there's a lot of debate on my timeline from intelligent infra people about whether we even need them, but there are 6 startups building them. And this was an idea that was floated about 6-7 months ago. To give you another example, in the last month, I've actually been pitched by 3 separate teams building G2 for Monad. And this is not a claim that G2 for Monad is not a big opportunity, but the fact that there are 3 credible teams building in that space prior to the launch of Monad is just a sign that I think there's way less alpha in infrastructure ideas now. And so either you have to have like some sort of distribution or execution edge. Otherwise, the market just like does not have room for that many of these startups. And I think that's part of what we're seeing with the tokens as well. Like one of the things about Layer 0 is that like everyone was surprised by the token launch, and I was as well. But the truth is bridges are like a disgustingly competitive sector in crypto. Like you have Wormhole, you have Layer 0, you have Across, you have Axelar, you have all these well-funded intelligent teams going after the same space. And at a certain point, like the market will not reward all of them. And this kind of comes back to something that all VCs are repeating these days. But one of the things you'll also notice is that the application layer is actually far less competitive. And so I know there are now pump.fun competitors, and Dex Screener tried to launch one. But look, like pump.fun launched and it seems to have like created a pretty good moat for itself. Something like a Fantasy Top or something like a time.fun. I don't know how successful they'll be in the long run. But the truth is that there's lots of like blue ocean in the application space. And even, for example, deep in startups, it's not like there's like 6 Hive mappers. And so broadly, I do think like it is true that there are some spaces in crypto that have become too legible. And I think this is going to become much worse in a bear market because right now, like if you're building pre-confirmations, you can probably get funded. In a bear market, you won't. No one is going to be willing to fund the 7th or 8th. And so I do recommend founders kind of think a lot more deeply about like whether the space they're building in is too legible. Like one more example of this is when Ethereum launched staking. Lido launched, and for like 9 months, there was no competition. It's crazy to think of that like Rocket Pool launched 9 months after Lido, and Lido was just sitting around for 9 months staking in all of the liquid staking deposits. Before EigenLayer launched, there were 5 separate liquid restaking token projects. And so I do think like a big challenge is just that like infra opportunities are way too legible these days. And that's something that I think founders need to be thinking about and try and find either crazy distribution and execution edges or just look in places where other people aren't looking.
Yeah, I mean, that was the entire thesis for Tangent, right? When we first started, we were like, okay, this infra circle jerk cannot last forever, right? There's only so much bigger the crypto market can get without actual users. If we just keep solving very crypto native problems, I get a lot of these problems are, very, very essential for builders, right? Solving MEV is obviously very important for infrastructure, but we cannot have all the capital in the space disproportionately flow into these infrastructure products because the promise every cycle that we've been given is that, the infra is not good enough yet. We need to have better infra. That's why we don't have apps. But the flip side is also we haven't had a need for very, very good infra because there hasn't been an app where there's more than 50 million users. So it's a chicken and egg thing. I get it, but I do think to really break us out of this constant PvP, which already started to see this cycle where the creation of wealth in Toto 3 is less than Bitcoin, which is a crazy concept, right? If you think it feels like we had a big bull market because we did, right? Prices just pull multiples for all of the majors. But the fact that we created more wealth in one kind of digital gold than this massive Web3 vision and all these kind of extremely technical, massive challenges that we talk about every day, and that only created half of the value that digital gold created, that's actually insane. I think everybody should be very surprised by that. And I think the reason that is because there's just not enough users. So we, obviously there are some exceptions. I like to cite the example of Pixels, even though there might be some bots there, millions of daily, I think at one point they reached like 1 million daily active users. That's still numbers you rarely see in crypto outside of exchanges and so on. So I think backing applications is the way to get out of this, if you really want to create some sort of a super cycle, you need to back applications to get people in. So that is one way to get us out of this. But again, obviously, I think both of us are very, very bullish on this, right? I was tweeting about how I genuinely think crypto is at least 10x bigger as an entire market within the decade. And I was looking at a lot of AI stuff recently, especially in the past 12 months, and it all seems to lead down to a role of massive centralization, right? You have this recent announcement of Apple Intelligence as well, and all these big AI companies working together. So it seems to me like crypto is almost like a counteracting force to this. And Peter Thiel actually called this many years ago. I think he said that AI is communist and crypto is libertarian. So it's almost like counteracting forces that are equally important in our lifetimes. So I think you and I have both kind of dedicated basically our careers to this. And I put in most of the majority of my personal savings into this. We've backed so many things that we thought could be useful but didn't work out. So in long term, I think it's unquestionable in terms of our conviction in space. It's just, okay, in the interim, do we get to buy things 50%, 80%, 90% cheaper? Those are the conversations that I try to, those are the conversations that I have in my head at times like this when I start to see some of the frothy signs of fatigue that you mentioned.
Yeah, 100%. I mean, I've bet my life on this in as much as I also work at a fund that is, like venture funds are long only. Like there's nothing we can do other than long things. Like we are effectively just long crypto succeeding. And so that's very much a bet I've taken in my life and feel very comfortable with.
And I guess in terms of like, if you think about for the last bear market, for people who are not around, not to post too much bear porn, but what are some of the horror stories you remember, man? Like you said the bear market to you in your mind is like after FTX. What happened after FTX?
The scariest thing was just this idea that like, we may have got a lot of our ideas and stuff wrong. And I think just having, like for me, it was very apparent that a bunch of very sharp builders had kind of decided this place was scammy. And there's still people who believe that, and that's a challenge that crypto faces. But just the thought that like, okay, like I've bet my life on this, and if the space doesn't get a lot bigger and remains kind of a niche asset class, then I'm kind of screwed, particularly as a venture capitalist. And that's kind of why, if you, like people who are talking about bear posting today, like just comparing it to the vibes then, and my vibes are really based on like who's building something interesting. Like, are people still betting on this technology being interesting? I'm like much less stressed right now. Like there are tons of people building things. Every week someone announces something exciting. For an infra nerd, this pre-confirmation stuff is fun. Yesterday, Solana announced this super cool way of kind of being able to link Solana actions to links. And you can just kind of like, I don't know if you saw, you can like now basically buy a meme coin or stake Solana or like do some action directly through Twitter. And so people continue to build very cool shit in crypto. And so, I don't know, the vibe was so bad then that like now feels totally fine.
No, I agree. So the reason why I'm not like very bothered by a potentially extended period of lower prices is because every cycle, if you've been around since like 2018, you know that there was existential threats to the entire crypto space every cycle during bear markets. So in the 2018 cycle, it was the fact that crypto was literally vaporware. It's all just promises. Nobody's building shit. There's no DeFi yet. There's no apps. It's just infrastructure jerks. And there's a very credible probability that the entire space just goes away and this becomes some sort of like cypherpunk niche hobby. And then by the second cycle, we have DeFi, NFTs, games, like actual users who don't really give a shit about cypherpunk ideology. They're just here because they can make money on some games or they can make money trading some interesting things. And that was already product market fit. So you know, okay, at least this is going to stick around. And then after this cycle, there's more robust infrastructure and we start to see some social apps as well. So yes, I might be skeptical of pump.fun and, you know, mixed views on meme coins, but the fact that it's getting mainstream people in to maybe check this out, set up a MetaMask wallet, set up a Phantom wallet, start to use different crypto things, I think that is quite hard to take away, right? Once that mind bug has taken hold in the minds of the mainstream, that's really hard to take away. I think that the scary thing for me actually for this cycle was after FTX, when the mainstream has kind of fully condemned crypto and AI was starting to take off, and you have these kind of bigwigs, Silicon Valley guys saying, hey, pivot to AI. I thought there's a genuine chance that we get brain drain. And I started to see this in one of my own portcos as well, where they just kind of pivoted fully to AI, which is really smart people coming into crypto and realizing the market is shrinking. Let's work on this AI thing instead. Because smart people like to go where they think their big challenges are or when the big opportunities are. So secular brain drain was a big kind of fear for me in terms of like existential level threat, which I don't think enough people talked about. But by and large, I think that's kind of also done away with now that the initial novelty aspect of ChatGPT when it first came out has worn off. And a lot of these ChatGPT wrapper startups have completely died just because OpenAI just killed all of them. So yeah, this cycle, I just don't see a lot of existential threats, especially with institutionalization of Bitcoin and ETH, which means like mainstream has fully accepted these things, and also friendlier regulatory stance in US. So the long-term outlook is extremely bullish for me. And I think people are just very confused about how I'm able to have this view, but also have this kind of bear market framework. So hopefully what we discuss is clear enough for people to understand that, you know, we try to operate on different time frames, right? So for VCs, they operate on 4, 5, 6, 10-year time frames, and they don't have to worry about the kind of later stage type of concerns. And I think, Sanat, you made a really great point. For growth stage investors or liquid market participants, these are the things that they have to really pay attention to in order to either grow their ownership in networks they're bullish on by, you know, keeping their cash and buying 50% lower, or not blowing up by levering up too early. So I think this last part of the session, I want to turn to Twitter a little bit. A lot of people have questions since my initial post. So I'll just go through a few of them here and see if we have thoughts we can bounce off. So the first one is someone asked for my low targets. So I don't like to give price predictions. That's not the point of the show. You know, honestly, as I mentioned before, I think alts can do whatever. Right, they've been down 30, 40% since I first shared my view. In most conventional definitions of the bear market, that even by crypto standards, that's like half of it already. I just didn't expect it to play out so quickly. But to me, it doesn't really matter where prices are in terms of my biases. Like, I'm not going to set my bias based on how low price goes. If anything, I want to see some sign of reflexivity up. Like, I want to be invalidated on the way up. So like if Bitcoin breaks above 73, given how reflexive it is as an asset, if you look at ETF flows as well, a lot of them tend to lag prices, which means people pile in after prices have gone up. Because of how reflexive it is, it also occurs the same on the downside, right? That's why you have these massive intra-cycle drawdowns. With Solana, last cycle traded at $250. At the lows, it was $19 because people were just selling and selling and selling. So I want to see some sort of reflexivity on the way up to prove me wrong. And there's really no way to say what price that would kick in at, right? But the rough framework I would go by is, you know, with as long as Bitcoin is within this 58 to 73% massive range, it's a little bit hard for me to say with high conviction that, you know, we're out of the woods. Is that kind of how you view things as well, or is this just not something that you have to concern about?
Much more the latter. I definitely don't have price ranges in mind. At a high level, I think if, let's say 3 to 4 months after the Ethereum ETF, Ethereum still isn't able to break all-time highs or be at least at 5,000 or like somewhat a lot higher than it's been previously, that would be a sign that at least our time frames for how excited we should be about this stuff may be wrong. I also totally agree with you that I think the stage is definitely set for, and I thought this last cycle as well, and it didn't really happen, but I do think the stage is set for Bitcoin and Ethereum to start following different trajectories from a whole number of alts. And so I certainly would not say that like all alts are going to go up or anything like that. I'm totally with you that thesis feels almost too brain dead for it to work at this point. And yeah, I think that's where I would end. I think just hoping that the Ethereum ETF in a few months after it. The other thing that is always a little depressing to see is like a big divergence in equities and crypto, which is something that we've been seeing recently, but it would also not be a great sign if kind of equities continue to reach all-time highs while Bitcoin and Ethereum kind of lag.
No, I definitely see that in this cycle as well. I think that's a good point, right? In terms of not needing to worry too much about kind of mid-time frame prices for secular investments, which is a point we keep coming back to, kind of this point about navigating time frames. Okay, second question that people had for us is, well, for me, I guess, when do I get back in? So I think the binary that people post is that, okay, if you have a somewhat bearish view on the market, you are either completely short or you're 100% cash. That is actually not the case, right? For most, if you know what you're doing, risk management is a spectrum. You could be very bearish on the market but still be long. For instance, some hedge funds, even in TradFi, right? If they are very defensive, but they think maybe there's a probability that the market could explode upwards, but they're not very sure, it's low probability, high magnitude event, they could be completely in cash, but buy convexity, buy long calls, right? So that is one example of how people can express one view and be hedged the other. That's why they're called hedge funds. And then, on the flip side, if people are very, very bearish on the market, but they want to maintain exposure to networks they have or equities they have, bullish view on, they could buy puts and completely delta hedge the entire portfolio, which means if the market crashes tomorrow, they more or less maintain the value of their portfolio. So risk management is a spectrum. I don't want to go into too much of our own strategies there. But in terms of, when do we get back into it? I'm a secular investor in venture. Like you said, it really doesn't matter if you get in early enough. Do you really worry about, hey, is this thing raising at $10 million or $5 million? Because if it fails, it's going to go to zero. And I've seen many zeros in my life. But if it succeeds, you might get 100x anyway. So the whole point of venture investing is to be secular. And the reason why I pay attention to liquid markets is because we can't raise money as a prop fund. So we have to make sure we have enough money to keep doing these venture investments. So that's kind of the answer there. I know it's not the answer that people want to look for. People want to know exactly what price I'm going to buy certain assets. But again, risk management is really a spectrum. And then the last one, this one I'm actually curious your take on as well, because someone asked, if you're bullish long term, why not still have exposure now in case of a white swan event or unknown bullish catalyst for the sake of a potential 10 to 30% drawdown, because the upside return far outweighs downside for crypto?
Yeah, I mean, I agree 100%, which is why I'm actually like a significant percentage of my net worth is in Bitcoin and Ethereum. Like I literally would never be like, I would never try and be like, let me sell Ethereum at 3,600 because I think I'll get to buy some more at 3,100. Like I don't have the time and energy for that shit, honestly. So I'm just happy to be long Bitcoin and Ethereum all the time. It sounds inane and kind of unintelligent. But in the long run, I'm pretty convinced it works out. So I think this actually makes a lot of sense. The pain of not being long Bitcoin, if it happened to have a huge run up because I thought I could buy in 10% lower, would kill me. So regret minimization, 100%. I'm all the time pretty much invested in Bitcoin and Ethereum.
That's the GigaChat diamond hands bull versus the virgin bear like me. So I agree. I actually agree with this. So if my perceived downside is 10%, I would not bother. My time and energy is much better spent actually reading what's new or trying out new apps. I'm not going to try to stare at my charts all day. I don't want to be one of those guys that wake up and just look at TradingView and then try to figure out, okay, is price going down 1% or 1% up or down? I know some people trade on the 1 second chart, which drives me crazy. So for me, regret minimization is two ways, right? One is, like you said, I'm underexposed to things that I'm bullish on because of some short-term view. The other is also not kind of paying attention to things that I would consider disastrous. So what I would qualify as disastrous is if the value of my portfolio can halve. That is kind of my rough framework. So if I think my holdings can halve, or on the flip side, if I'm in my cash right now and price is half and I can double my size in networks I'm bullish on, I think that warrants action. But that's why when I mentioned that my job as an investor in crypto, at least on the liquid side, is purely to look at inflection points, is because inflection points are supposed to preempt those kind of 50% drawdowns. And to a certain extent, for a lot of the alts, if I was fully exposed to alts as I was expressing that view, my portfolio would probably be 40% lower. So it's like scenarios like that I want to, avoid. If it's a 10, 30%, who cares? It's crypto. So volatility is part of the game. So hopefully that answers most of you guys' questions out there. I know you guys will have more questions, especially given something like this. So just tweet at me. I'll reply there. And thanks again for dialing in. Hey, thanks for supporting another episode of the Blockcrunch podcast. If you've enjoyed this episode, please give us a 5-star rating on Spotify and Apple Podcasts or whatever platform you're listening to this on. It really helps us a lot. Or if you prefer YouTube, you can subscribe to our channel on YouTube as well to not miss an episode. I'd love to hear from you guys as well, and I personally make sure to read every single comment on YouTube or tweets that are directed at me. So feel free to leave a comment there. Let us know what project you want us to bring on or what trends you want us to talk about, or tweet at me at Mr. Jason Choi or at the Blockcrunch on the platform previously known as Twitter, currently known as X. And thank you so much for supporting, and I'll see you in the next episode.